Hello and welcome all of you once again. Today we're going to discuss about an important concept, and that is the calculation of premium for term life insurance. Life insurance as a chapter is an important one in your FMP curriculum. And I have picked up one particular problem which we are going to discuss and see that how the premium is being calculated. So without much ado, let's dive into the problem. Okay. So here in front of you, you could see that there is a something called as a mortality table. So let's first get familiarized with the mortality table in order to, before we enter into the problem solving. So let's first understand the different columns. So the first column, as you see, is that of the age. Okay. The column number 2 is we have taken male on this end and female on this end, right? So within male, the column F reads as probability of death that is unconditional within 1 year. And column number G says probability of survival that is conditional within 1 year. And the column number H happens to be the life expectancy. For our purposes of calculating premium, we could ignore this particular column. The same notation applies here as well, appears here as well in case of females. Probability of death, which is unconditional, happens to be in column number J. Probability of survival that is conditional, that is column number K, and then L column is life expectancy. We could ignore this column. Okay, now why actually I'm emphasizing on these headers? Let's get a quick understanding. Unfortunately, your GARP book, and I'm sure that most of the third priority prep providers book as well, do not quite actually evince the real genesis or the rationale behind actually behind the mortality table. They do produce these columns as we are talking about, but I do not think that you will see this word unconditional and conditional here. Now, this makes all of a difference because unless you have a good understanding of what is meant by unconditional and conditional, I do not think that you will be doing justice to calculating the premium. So let's understand this from a holistic perspective. First of all, let's take an example that somebody is born today. That is time t is equal to 0. If we expect the person is going to live up until his 70th year, so right from today till here, this is his entire lifespan. This is his entire lifespan. Now, we need to understand one thing, that death will only occur once, which is to say that our survival is actually a complementary to that particular event. Death is the ultimate truth. We all will have to face it one point in time or another. It's just a matter of time. Some might be pretty premature. For some, it may be premature, unfortunate, but yes, it could be true. Some might live up to a standard or an average lifespan, which I'm talking about is 70 years. Okay, so if we take a healthy individual, suppose who is 20 years old today, the probability that he's going to live up to the 21st year is conditional that he does not die within this span of 20 and 21st year. That means this 1 year, within this 1 year, if he does not die, then definitely he will live up to the 21st year. And same goes as far as this practice is concerned for all the succeeding years. So if you take the timeline of, let's say, 25, so again, the same thing would happen, that the probability that the person is going to live up until his 26th year is a function that the person does not die between the year 25 and 26. Now, The moot question out here still is that where do we get this data from? Well, this data are probably published by the National Bureau of Statistics for every country, and the insurers, the insurance companies that operate in those geographies, they would refer, in fact, to be very precise, the actuary of those insurance companies or the actuaries who support these insurance companies' business would actually refer to this statistical data. So, for example, if we are talking about, let's say, a 30-year-old male, the probability that the person would survive, the person may die between the year 30 and 31st is 0.001498, which if you translate this into percentage term, it happens to be 0.1498, roughly speaking, 0.15%. Okay. Now, what is the probability that if he does not die, what is the probability that he is going to live up until his 31st year? Well, the possibility that he's going to live up his 31st year is conditional on two things. First of all, he will have to live up until his 30th year to see the 31st year, which is to say we are really talking about a cumulative probability of a person who was born, let's say, 30 years back. The probability that he survives up until the 30th year, and then we will adjust it with the probability of death between 30 and 31st year. And if he does not die, then surely he is going to live up to his 31st year. So how do we calculate that? Now, what I want all of you to do is pay special attention to this. If we take this probability of death as 0.15%, so we simply, we deduct this probability of death. This will become, let me just do the calculation at my end as well. So this is in percentage 0.1498. So 0.001498. This to be deducted from 1. So that happens to be 0.9985. So this 0.9985, and now if we have to come out with the probability that he survives up until his 31st year, we will simply have to multiply this with the survival probability of the person till 30th year. Because as we have said before, that the person needs to survive up until his 30th year in order to see the 31st year. So if we multiply this with 0.9752, I'm referring to this cumulative probability of his survival up until the 30th year. So this comes out to be 0.973739. Okay, exactly this particular figure, right? And if you do this in a recursive manner, you will see that the probability that the person survives up until his 32nd year is again a function of two things. First is that he must survive up until his 31st year. That is the 0.97373. And second, the probability, the adjusted probability of him not dying between the 31st and the 32nd year. So if you want to actually do this math yourself, you could do it, and I'll just repeat this once again. So I'm taking this particular year between 31st and 32nd year. So we say 1 minus 0.001536. This, if we multiply by 0.97373, so you will get, if you do this math, you will get the figure of 0.97224, exactly this figure. Okay, so if this basic notation is being understood, then the rest of the math will become relatively easier. Okay, so what we are going to do is that we are going to take an example. I have certain worksheet already done, but nonetheless, what I will do is that I will take out this worksheet and redo this math for all of you in order to glean out of the underlying concept. So let's take an example of, let's say, you could pick up any age group, any particular aged person, and it really does not matter whether it's male or female. The math remains the same. Let's say, still, I will just go with the flow out here. So let's say we are talking about a person who is, let's say, 70 years old, right? And this person wants to insure himself, insure against his life for the next 3 years. For the next 3 years, he wants to insure his life, right? So that means he is going to take this policy on his 70th birthday. I'm just making it a little bit more easy for us, or a little bit more relatable. On his 70th birthday, he takes out this insurance policy, and he's going to ensure that he is insured. He's going to insure himself up until his 73rd year. So this is basically 3-year policy, term policy, that he's taking out. Okay, and let's say the sum assurance for that is $1 million, which means it is about this much in absolute term. Okay, now with this understanding, let's calculate that what should be the fair value of the premium. If you were an insurance company, how would you price this particular issue or in this particular product in our understanding? So, but obvious, if you study this mortality table a little bit more minutely, you will see that the probability that the person would actually die in the next 1 year increases as the person ages, which is but natural, right? So if you're talking about a healthy person of 30 years old, his probability of dying in the next 1 year is just about 0.15%. But if you compare that with, let's say, somebody who is 70 years old, the probability that he is going to die, or let's say somebody who is even 52 years old, the probability that he's going to die is somewhere around 0.599 or close to 0.6%. So that's a significant increase. Similarly, if you compare that with, let's say, a 90-year-old person, the probability that he's going to die in the next 1 year is about 16%, right? So, and accordingly, obviously, as this increases, as this probability of death increases, the probability of survival for 1 more year obviously comes down proportionately. And the exact math we have just worked out in the last couple of examples. So let's return to our example and let's see. We are talking about year 0, 1, 2, and 3. And here we are talking about a 70-year-old person who is taking out this policy, and the sum assured is 1 million, right? So how you as an insurance company, how you do price this product? So before we again get into this calculation mode, let us agree on certain aspect. So as with any particular product, I'm sure that if we are to find the fair value of that product, the first thing that we need to understand is what is the likely cost of that product be, right? So from the insurance company's perspective, the likely cost is nothing but the claims outflow. What is the likely claims outflow? Now, you would see that we have already tied this with a $1 million maturity claim. So why exactly are we interested in finding out what is the likely claims outflow? Well, because of one thing, that should death occur, that means if there is an eventuality, no doubt the insurance company will have to shell out 1 million to the beneficiary of that policyholder. But not all 70 years old die, and not all 70 years old die at the same time, in the same year, and much less on the same day. So that means it's more of a probability game that the insurance companies bank upon. More precisely, it's a pooling of risk and reward on a probability adjusted basis. So when we are talking about the likely cost of or the claims outflow, this we will have to balance out with the probability adjustment. Okay. So what does come to our mind? So it comes to our mind is that let's first try and figure out what could be the likelihood of claims if there is an eventuality for this 70-year-old person, right? So as we could refer to the table, that the 70-year-old person, if he dies in the next 1 year, his probability of his death is obviously, as it has been mentioned, 2.33%. So What is the probability adjusted claims outflow there? Well, it is going to be 1 million multiplied by 0.02338, right? So this is the probability that the person may die, and this is the probability adjusted payoff. Okay, so I'm sure that you could do the math, and that is going to be somewhere close to 23,000, 3,000, 23,000, sorry, it is 233,800, 233,800. I'm deliberately not using the Indian terminology of lakhs and 10 lakhs. I'm using the American or the English terminology of thousands. Otherwise, we would have called this $233,800. So we say it is $233,800. Okay, so this is the likely claims outflow if the person dies in the first year. What is it going to be for the second year? So if it is second year's probability is 0.00259, right? So if we do this, so we should be getting somewhere around 2,55,490, right? Isn't it? Wait a minute. No, that is not the answer. Why? Because as we have understood before, that you may only die once. Am I right? This is exactly what we talked about here as well. You may only die once. You may only die once. So if I were to die in the second year, that surely means that I survived the first year. So when we have to find out the likely claims outflow in the second year, that has to be probability adjusted and is conditional on the fact that the person survives the first year. So as before, what is the probability that the person is going to survive between the 70th year and the 71st year? Well, it's going to be 1 minus 0.0238. This is the probability that the person is going to survive. So if you do this math, it should be immediately 0.02338. It should be 0.97. This comes out to be 0.97662. Now this 0.97662 is the probability that the person is going to survive between the 70th and 71st year. Now, what is the probability that the person may die in the between 71st and 72nd year? That is 0.025549. Yes, now if we are doing this math, we will have to adjust this now with the conditional probability of survival, 0.025549, 0.5549, which is coming out to be 0.2495. This comes out to be 0.024951664. So this is the probability adjusted death. Probability adjusted death for the person who survives between the 70th and 71st year, and yet he may die between 71st and 72nd year. So naturally, if we have to map with the claims outflow, the probability adjusted claims outflow is going to be 1 million again into 0.024951664, right? So this probability adjusted payoff comes out to be somewhere close to 24,9517. Similarly, if we move to the third year, why we move to the third year? There again, the same thing is going to happen. That means that the person will have to survive between probability of death of a person in the 70th year. This is the probability of survival between 70th and 71st year. And then the probability of survival of the person between 71st and the 72nd year. This is the probability of survival. And then now if we'll have to multiply between that he dies between the 72nd and 73rd year, that happens to be the unconditional probability of death in between the 72nd and 73rd year. which comes out to be here, if you refer to the fact, so this comes out to be 0.027885, 0.027885. This one is 0.027885. Right. So when now please do remember, at every instance, at every age group, this figure which has been provided by the National Bureau of Statistics is pretty unconditional in nature. As an insurer or as an actuary working for the insurer, my job or your job is going to be actually to find out the conditional probability that the person may die in any of the policy year, along the policy year, right? So when you again do this math here in the same fashion that we did here, just to remember that we have to do this recursive function twice to find out the third year. So in that case, the probability adjusted payoff is going to be somewhere close to 265373, right? Do remember that these are all probability adjusted payoffs should the person die in any one of the policy years between the 70th and the 73rd year. Because we have taken out the policy for 3 years, right from his 70th year, once he has crossed 70, from 70, 71, 72. So these 3 years are in continuation. Along these 3 years, he may actually die in any of the years. But when any of the years he may die, these are likely to be the probability adjusted payoffs. So in the first year, this happens to be 233800, that is 233,800. In the second year, it is going to be 249,517, and in the third year, it is going to be 265,373, right? So let's just regroup this once again, that we take this year 1, this is year 2, and then this is year 3. Now the probability adjusted payoff, so we write here probability adjusted payoff. So if we do here, so we would write here as 233,800. In the second year, it is going to be 249,517, and in the third year, it is 265,373. Okay, so what else is remaining? Well, the next thing that is remaining is to find out the present value of this, because we have to price this at year 0. Here we have to price this product. This is the forward projection. So if we have to find this, so that means we will have to suitably discount these payoffs. We have to suitably discount these payoffs, right? How do we do this? So let's say we have the risk-free rate of interest as, we will take this here example is, so risk-free rate of interest has been enumerated, or it has been pegged at 6%. So we take this 6%. So if we take the 6% as risk-free rate of interest, so all that we are required to do is to discount this at the rate of 6%, right? So we discount this at the rate of 6% for the first year, we discount this at the rate of 6% for the second year, and discount this at the rate of 6% for the third year, right? And if we do that, and then if we add all of them, then that will give us the probability adjusted payoff across all the 3 policy years that we are talking about, right? No, not quite exactly. Why? Well, here lies another trick. Invariably, when we do acknowledge that these are going to be the payoffs, we are inadvertently also estimating or assuming that he dies. Let's say this is the first day he takes out the policy. So if he takes out the policy on his 70th year, and then this is the first year, that means this is the 365th day of the first policy year, and this is the 365th day of the second policy year, and this is the 365th day on the third policy year. Of course, when we are doing this, we are inadvertently assuming that that magically this person may actually die on the last day of the policy itself, right? Which obviously is a little bit of a fallacy. The person may die at any point in time, and of course we do not have any control. Only God can give or take somebody's life. So it is quite possible that the policy, even after taking out the policy, the person may die on the second day itself, or he may die 6 months down the line, or he may die 2 months after 6 months, that is 8 months, 9 months down the line, he may die. So we really do not know, right? So because we do not know, we still have to come to some point in order to find out the present value. So the better estimate may not be the best one, but the better estimate is to actually understand, or we assign the midpoint value as the death. So that means if we are to say that after the initiation of the policy each year, 6 months down the line, that is our best guess that we can talk about, because in this case we are not favoring on the early death, we are not favoring the late death within the policy year itself. So if we go by this logic, and please do understand, there is no right or wrong to it, and neither this is the best method to find out the term for the policy, but under the given circumstances, this perhaps there is no better other alternative, and this is exactly how the insurance companies work. So in this case, for the first cash flow, that is this cash flow, if we assume the midpoint of the death here, so practically this midpoint is 6 months, and this midpoint is going to be somewhere around 1.5 1.5 years, and similarly this is going to be somewhere around 2.5 years, right? 6 months after each policy year begins. So with that understanding, when we actually discount, so we will have to discount them suitably. So then the first cash flow, which is here, we discount this by 233,800. This we discount by 1 plus 6%, but then we will assign it to the power 0.5. Similarly, the one out here, 249,517, this when we discount at 6%, we're going to assign a power of 1.5, and the last cash flow, which is 265,373. This when we discount at the rate of 6%, we are going to assign the power of 2.5. So if we do this math, yes, so if you do this math, the values are going to be exactly, for the first year it is going to be 227,087. For the second policy year it is going to be 228,634, and the third one is going to be 229,399. So if we have correctly discounted, so these are going to be the likely payouts. So since we have gotten this, so I think now our job is done, isn't it? So all that we have to do is to add all of them and then divide it by 3. Why should we divide it by 3? Simple, because if this is the so it comes out to be 685,120. So this is the whole likelihood of probability adjusted payoff for a 70-year-old person taking out a 3-year policy for a sum assured of 1 million. Now, if you have to price it, one might argue that you simply divide it by 3 and there goes the policy premium. If we do this, then we are going to get 228,373, and this should be our policy premium. Is not it? Sounds fair? Well, not exactly. Why? Because what does the policy of insurance say? The policy of insurance says that a person pays the premium here, because unless the premium is being paid, the policy would not come into effect. So when he pays the premium here at the 0th day, he's paying it for 1 year. He pays the premium here at the end of the first year's policy for 1 more year's policy, and he pays the premium here once again for 1 more years of policy coverage. That is how it pays. But then again, eventuality can happen at any given point in time. Obviously, a dead person cannot pay a policy premium, neither is it required. It goes against the very ethos and the principles of the life insurance itself. So that means that when we have to talk about the premium payment, we will also have to do certain adjustment as regards the probability of his survival. We have gotten, make no mistake, we have gotten the claims side, that is absolutely fine. But now we have to find out the probability that the person is going to remain alive and he has the inclination to continue the policy and make the premium payment. Okay. So here, on the 0th year, the probability that he is going to survive and make the premium is always going to be 1. Why? Simple. He is alive. That is why he is taking out the policy. So the probability is definitely for the first year, it is always going to be the 1. What about the second year? Well, at the second year, the same principle follows, that the person will have to survive the first year in order to pay the premium for the second year. And what is the probability that he might survive the first year? Well, that is 1 minus the unconditional probability of death, just the way we did it. So 1 minus 0.022338. Which happens to be, we just did this 1 minus 0.02338. So which happens to be 0.97662, right? And what about the third year? Well, the third year, again, the same principle will follow, that we will continue to believe that he survives the second year. That is how he will make the policy payment for the third year. And what is the probability that he may survive the second year? Well, that is again 1 minus 0.025549, exactly this which we have gotten here. So if we do it here, so 1 minus 0.025549, 0.025549. So it is going to be 0.97445. So it is going to be 0.974451, right? So now we have gotten the probability adjusted survival of this person over the next 3 years. Obviously, the first year, the probability that he is going to make the payment is obviously 1. Here, the condition that he survives is not very important. He is alive, that is why he's taking up the policy payment. So let's say he pays a premium of X every year. So that means he pays a premium of X in the first year, X in the second year, and X in the third year. So what is the probability adjusted premium that he pays over the next 3 years? Well, that's simple. All that we have to do is to multiply them to find out the probability adjusted way. The first year is going to be X. The second year it is going to be 0.97662X. And the third year it is going to be 0.974451 into X. Right. Now that we have gotten the premium that is being paid on a probability adjusted basis for all the 3 years, all that we have to do is to add all of them. So if we add all of them, we should get 0.97662 plus 0.974451 plus 1. It is going to be 2.9510x. 2.9510x. Now, all that we have to do is, if we have to fairly price this, because that is exactly what our idea was, to fairly price this insurance policy for a 70-year-old person who is taking out a $1 million policy for the next 3 years. So if we have to find out the fair price, then I think this logic should stand good, that for a fair value calculation, the policy price of this policy must just be equal to the claims outflow that it is likely to make on a probability adjusted basis, and that too on a present value basis, right? So that means that the present value of claims outflow, over the next 3 years, must be equal to the present value of the premium being paid. Premium paid is all still X. It's a level paying premium. We are talking about a probability adjusted basis. Both of them are probability adjusted. All right. So if we equate this, so probability adjusted present value of claims outflow over the next 3 years, we have already gotten as 685,120, and the probability adjusted that the premium will be paid over the next 3 years, we have gotten as 2.9510x, which means x is going to equal to 685,120 divided by 2.951. And this gives us a value of 232,159.78. We simply simply round it up to 232,160. And there is your fair value of this particular term insurance policy for 3 years for a 70-year-old person and a sum assured of $1 million. So I hope that you have had a detailed understanding of how the insurance policies are being priced. Do remember that this is just the fair value of the policy. The insurance company may add certain other charges as well, which means that it is going to talk about the office and expense ratio, etc., etc. Those things are also there. So that means that the premium is going to be a little bit slightly more than $232,160 per year. It is going to be perhaps, let's say, somewhere around 234,000 or 235,000, wherein the office expenses are also being added with the requisite markup for an insurance company. But if we are to find out the fair value of this insurance, this is the fair value of this insurance. So I hope that this particular workout has been helpful for all of you, and you could actually find out if your exam. I do not think that such detailed questions will be there, but if they are given, I'm sure that you will be able to solve them. Thank you so much.